Last week I gave you my reasons for saying goodbye to COIW and hello to BLOX. On today's episode, I'm going to explain why I'm getting rid of SNOY, and I'll give you an account update after a really ugly end of the week. So stay tuned. I'm on the hunt for an infinite stream of dividend income. My plan is to turn $1,000 of Robinhood's money into $1,000 of my money. And nothing I say today is financial, legal, tax, or investing advice. I'm just a random guy on the internet. You need to do your own research for your investments in your situation. Let's get started. If you're new to the channel, or it's been a while since you've watched my original videos, here's a quick recap of my strategy. I invested about $2,000 of my own money into PAAA as my foundation fund. This investment is intended to maintain my $2,000 margin minimum and help me avoid a margin call. I've actually had to add to this foundation fund a couple of times, so in reality, I've actually invested about $2,200 of my money. I'm a member of Robinhood Gold, and that gives me a free $1,000 margin loan. You have to pay to be a member of Robinhood Gold, but I do that anyway to receive a 3% IRA contribution match. One of the perks is this $1,000 interest-free margin loan. I took that $1,000 and bought 4 ultra-high yield ETFs. The original funds were MSTY, SNOY, COIW, and NVYY. I since sold out of MSTY and purchased HOOW, and in last week's episode I explained how I was getting rid of COIW and purchasing BLOX. Every time I receive a dividend from one of these ultra-high yield ETFs, I split the dividend in half. The first half is reinvested back into the fund. The second half is going to my forever fund, which I chose to be SPY-I. This is a NAV-stable ETF that I hope I can keep for decades. Ultimately, I'd like to get this position up to $1,000 and then use all of the dividends to pay off the margin loan, which would leave me with a free $1,000 investment into SPY-I. The portfolio dropped about 1.4% this week after a significant sell-off the last couple of days. I'm sinking closer and closer to a margin call. I'm now only about 3.6% or $75 above my minimum margin threshold. PAAA is what is keeping me above this minimum. And if you remember, this figure here is calculated a very specific way. This $2,087 is the combination of the funds that I own outright, which are PAAA, and combine that with the losses that I've taken on the margin loan. I received my regular set of dividends this week. NVYY paid me 34.5 cents per share, which is about 101% annualized return. I split the $4.01 dividend in half. $2 was immediately reinvested back into SPY-I. The other half is waiting reinvestment later on. This fund has paid me $120.84 in dividends since this experiment started, and is by far my highest dividend payer. I received my final COIW dividend this week, a little over 23 cents per share, which averaged out to about 70% annualized rate. I reinvested half of this dividend back into blocks. I also added the 64 cents from last week into my blocks investment. And for some reason, I just missed the 58 cents from 3 weeks ago. So I've got that highlighted, and I'll reinvest that into blocks this coming week. My HOOW dividend came again this week, 38 cents per share, which is about 48% annualized. I now have 4 weeks worth of these dividends set aside to reinvest in whatever fund replaces HOOW. SNOY paid me its dividend on Friday evening at about 7.75 cents per share for a total of $1.37. That represents about a 35% annualized yield. Like I'm doing with the other funds, I'll reinvest these dividends next week, except for the SNOY dividends should be going to a new fund, which I'll get into in a minute. So I did sell my COIW shares this week and used the proceeds to purchase blocks. Here is my purchase log for COIW, where you can see I bought in July of 25 at about $59.50 per share. And all of my dividend reinvestments have just come at lower and lower share prices, all the way to the end where I sold out at $15.94. Coinbase has been on a real losing streak recently, and this last week was particularly hard. I delayed my sale because the RSI was getting low, indicating that it was oversold, and I hoped it'd have a turnaround. But as you can see, it's had a lot of down days in a row, and I just finally pulled the trigger. As soon as I sold COIW, I purchased shares of BLOX. Currently trading at $18.09, I bought in at $18.61. Crypto had a huge sell-off at the end of the week, which negatively affected this ETF. If any of you are interested in purchasing blocks on margin, Robinhood has a maintenance ratio of only 25%. The next fund I plan on getting rid of is SNOY. Here's a look at the total return chart of SNOY and its underlying SNOW. And this begins in July of 2025 when I made my first purchase of SNOY. Snow was down about 12% and SNOY is down about 13% over this period in total return. So SNOY has been tracking the underlying pretty closely with a little bit of lag. So from this point of view, I can't fault SNOY. It's pretty much keeping up, or in this case, keeping down with Snowflake. The real problem is if we change and take a look at the price return. So again, SNOW is down about 12% over this period, but the share price of SNOY is down over 36%. So it's been trading a significant amount of yield for NAV, and I just don't think this is sustainable to me. So I decided to make a change. But first, let's take a look at SNOY and what it's trying to do. SNOY is the YieldMax Snow Option Income Strategy ETF. Its primary objective is current income, and its secondary objective is exposure to Snowflake's price return. And this is spelled out in the prospectus. Current income followed by exposure to the share price of Snowflake. And unfortunately, Snowflake has been on the way down. It uses a synthetic covered call strategy, meaning it does not hold the underlying Snowflake stock. It uses options to replicate the long exposure to Snowflake. Then they use covered calls and covered call spreads to generate income. Here's an interesting look at the SNOY price return and the dividend amount since I made my initial purchase last summer. The price return is in orange and the dividend amount is in blue. You can see both are trending down. Dividend amounts have been high in the past. This one was $1.13 per share. Recently, we've been down in the 7 cent per share area. Of course, this graph is slightly misleading because around October, I believe, is when YieldMax changed from monthly to weekly dividend distribution. But even as recently as December, we were talking about 27 cents per share, and now we're down to around 7 cents. I've decided to sell my position in SNOY and purchase Chippy, CHPY. This is the YieldMax Semiconductor Portfolio Option Income ETF. It may be controversial to some for me to stay with the YieldMax fund family, but this ETF has been one of YieldMax's lone bright spots. It contains a basket of ETFs, also seeking weekly income and providing some growth opportunity. The prospectus is very clear. The primary objective is current income. The secondary objective is capital appreciation. CHPY has an equity strategy and an option strategy. It owns a basket of ETFs in the semiconductor space, and it aims to own about 15 to 30 companies. Currently, I believe it owns about 20. And these are stocks that the fund managers think will go up over time. Secondly, it has an option strategy, and they say they primarily use covered call spreads, and this is how they're going to generate most of the weekly premium. The fund is relatively new. It's less than a year old, but it's already accumulated over $300 million in assets under management. We can scroll down and look at the distributions, and they've been relatively steady. I'll show that to you in a chart shortly. If we look at the top holdings, we see a lot of familiar names, but what we don't see is Snowflake. Now let's take a look at total return comparing SNOY and Chippy. And this is over the time period starting when I first purchased SNOY in July of 2025. As you can see, the two funds diverged significantly towards the end of 2025. SNOY is down 13% in total return, and Chippy is up 35%. Let's take a look at the performance of the actual price return. Here we show SNOY down 36% and Chippy up about 9.5%. Finally, let's take a look at the dividend. Chippy seems to be a little more stable, and in general is going up a little bit, whereas SNOY has been going down. The total plays out the same on total real returns. The chart here shows a significant divergence in the later part of 2025. Chippy is in blue. And if we take a look at the worst drawdown, we see that SNOY is in the middle of its worst at minus 26%, which is over 2.5 times worse than Chippy's worst drawdown, which was back in November. So let's pull all this together and take a look at the similarities and differences between these funds. They're both from YieldMax, and they seek current income as their primary objective. Snowy's secondary objective is tied completely to the share price of Snowflake, whereas Chippy is looking for capital appreciation from a basket of semiconductor-related stocks. Snowy has a synthetic position and uses covered calls and call spreads, while Chippy relies on choosing good stocks that may appreciate in value and an option income overlay. I consider both of these investments to be high risk. Chippy is the newer fund, and its NAV trend has been up, while SNOY's has been down. Snowy definitely has an advantage on the recent yield, but I've learned that yield loses to NAV erosion, so I'm willing to accept a lower yield in exchange for a stable NAV or hopefully even a slightly appreciating NAV. Remember, when I first picked Snowy, I was looking for a 75% minimum yield, and I just don't think that's sustainable. Chippy has had the more stable dividend, and both of the funds pay weekly. Snowy uses synthetic positions and does not hold the underlying stock, whereas Chippy does. That's definitely an advantage to Chippy, in my opinion. Neither fund uses leverage. Snowy has no diversification. It relies completely on Snowflake, whereas Chippy has about 20 assets under management, and that can float around from between 15 to 30 assets. The expense ratios are similar, and even though Chippy's the newer fund, it has significantly more assets under management. The portfolio is down about 27% total, a 44% loss on all of my high-yield ETFs, offset by SPY-I's $174 profit. I am pretty happy that I now have over 3 shares of SPY-I based off of all of these micro purchases of half dividend reinvestments. So I feel good about that part of the plan. It's just these other high-yield ETFs that are failing me. What do you think of my decision to move from Snowy to Chippy? Let me know in the comments. And I'd appreciate it a ton if you'd like and subscribe if you found this entertaining or helpful. And of course, nothing in this video is financial, investment, or any kind of advice. I'm just inviting you along my journey. And if you'd like to learn more about my small account margin strategy, check out the first 5 videos in the series. Good luck hunting those infinite dividends.